Hi, Dominique, and welcome to another edition of Week Ahead. I'm happy to be back and doing it. How are you doing?
I'm fine, thank you. It's great to have our little shindig again. I was missing it, so lots to
Yeah.
discuss.
Yes, awesome. Okay, as we always like to do, let's kind of recap what stood out from you over the past week. I guess one thing clearly seems in a lot of the markets, volatility is kind of getting crushed. Certainly FX markets, I'm assuming rates markets, even equity markets. Um, and then a bit more of this narrative that maybe the US economy is somewhat slowing. And so I guess, and obviously any kind of central bank comments or anything. So yeah, what stood out from you, and do you agree with how the market's reacting to things?
So I think the market is overreacting to a couple of weaker than expected data prints, NFP, PMIs. As always, one data point doesn't make a whole macro backdrop. You need to look at the context. The weak NFPs may have reflected some weather, some seasonality issues. On top of that, the NFP was not that weak. It was still higher than the average for 2019.
Yeah,
And it seems like its expectations, as you all know, expectations are not forward-looking, they are adaptive. We had a string of higher than expected NFPs, so people thought they would raise their forecast, and then the actual data fell short. But the underlying is strong. And in terms of the PMI, I know that these are in the Bloomberg calendar, so I comment on them. I have my charts. But the fact is, if you look at the relationship between GDP and PMIs, it's broken down for the past 10 years or so. In fact, I think it's one of the things that Bilal discussed on our weekly call. So I think the market got a bit ahead of its skis. And it will be interesting to see if this coming week it gives us a reality check.
I guess the other thing is also that then we had the kind of weaker weekly unemployment numbers.
Oh, it's a
But then
fairly
again, I saw there was like something similar happened last summer, so maybe there's a seasonality. I'm not sure. Do you have a view on that?
Oh, sure. I mean, climate change has completely messed up seasonality, among other things, obviously not the most important consequence. But yeah, I mean, claims are a high frequency, but fairly low quality labor market data. And if you look at the trend, and if you look at it in relation to labor supply, I mean, it's not going anywhere. Still have a very strong labor market. And as always, we've been saying for a very long time, the issue we have when we see things like the unemployment rates creeping up is whether this is normalization, because we had such a crazy extreme policy response to the crisis that we had NFPs that jumped to above 500,000, 700,000, so completely unsustainable. And so it means that normalization is actually a slowdown in NFP, an increase in unemployment that fell to 3.4%. Last year, this was like the lowest since World War II, so clearly unsustainable. So the issue for us is always, is this slowdown we are seeing, is it just a garden variety normalization, or is it a sign of that growth is about to slow down a lot? And I think the former is much more likely if you look at everything that's going
Okay. Okay, great. Okay, cool. Let's kind of then dig in for the upcoming week. What do you think is the most important data that's coming out, any speeches, looking for market reaction, and obviously any other politics stuff that you think may be relevant.
Yeah, let's stick to the relevant and ignore the political noise. So obviously CPI and then retail sales, and then we have Powell is participating in some conference in the Netherlands. So the CPI, the consensus is 0.3% for core month for month. We, as always, rely on Sam's model, which has proved amazingly accurate to, give us an advance number. But I would say from a very broad macro brush perspective, I would see the risk more skewed to the upside than downside. One big driver of inflation is energy prices, and we get a fairly good read of that using the daily AAA pump gas prices, and it looks like it was up last month quite a bit. So that typically makes for a higher CPI number. Also, we know that housing inflation is stuck. Growth is strong. My latest piece is about immigration and how it's boosting growth number, and it explains a lot of the growth mystery. So all this to me suggests higher, the risk of higher is more important. That said, it's not going to change the Fed. The Fed wait and see, no change in outlook stance at the moment, because they don't pivot based on single data points, and they look at the broad macro context. So that's the CPIs and retail sales. To be honest, I look at the 0.2% consensus view for core. Core retail sales are basically the subset of the data used to compute consumption in the GDP. It seems a bit tame, especially given that, we have these large inflows of migrants buying stuff. In fact, one of the striking things about the inflow of migrants is that they are not sending more money home. If you look at the remittances data, it's not gone up, even though we've had a big surge in migrants. So it means their savings rate is low. And so that's very supportive of consumption. So again, I see a risk of positive surprise, won't change the Fed, but given how the market, in my view, overreacted to the negative surprises, we could have a little bit of a correction there, more in bonds than in equity, because when you think about it, the current regime where we have a surge in migrant workers that's keeping wages low. So it's one key reason profit as a share of national income is close to its highest ever.
Right.
And then we have inflation that's roughly stable above the Fed. But, I remember when I was an economic student and I used to ask, what's the big deal about 2%? Can't we have 3% inflation? So if the market is prepared to accept 3% of inflation, if it's roughly stable, actually this could turn out a fairly positive backdrop for equities. So we could have more of a move in bonds than in equities, if my view on the data is correct. And then the last important thing is, of course, Powell's participation. I think there is a Netherlands conference of private bankers, or anyway, he wants to speak to us. But I suspect he's not going to say anything new. He's going to stick to his let's wait for, you know, the current policy stance to play through the economy, blah, 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 and no change in the outlook, still expect the next move to be a cut. So that's my expectation for this coming week.
He still expects the next move to be a cut, you said?
Yes.
Fine, okay.
Yeah.
Okay, so you don't really see any big surprises there. And on the data side, the two very key, and not just next week, but for the month as a whole, you see potential for positive surprise on both. And together that could really push back on the cuts narrative that came back over the past week.
Absolutely. To me, but the most important thing at the moment is that this immigration surge has not been taken into account into mainstream economic forecasts.
Right.
The Fed is talking about it, but very gingerly, because unfortunately it's such a polarizing theme in the US. And in my own notes on immigration, I was very careful to use the term undocumented rather than illegal immigrant, simply to take away the negative emotions out of it, and look at it as a macro issue, which it really is.
Right.
And so the Fed is talking about it very delicately because of the political sensitivity, but it's not in the mainstream narrative currently. And I think that's why people are underestimating the growth.
Right. So it may not be amazing for American workers, but for American companies, it's increasing demand and keeping wages low. So
exactly.
the combination is pretty good. And then any of this, I think we just touched on it briefly before we started. These new tariffs, I don't know if, I guess they can't unilaterally, Biden administration can't unilaterally push it through, right? It has to go through Congress.
Actually,
Or how does that work?
Actually, they can.
Okay.
They have special authorities, which I think was instituted in the 1970s, so they can.
Okay.
It's a scoop from Bloomberg, unconfirmed yet. I'm not very sure what the administration expects to get out of it. You know, if the tariffs, the increases that were implemented by the Trump administration had no impact on inflation, largely because goods are only about 1/4 of core PC weights. And also because this was a low inflation regime. So
yeah, we were a different environment.
It washed out. This time around, I mean, yeah, maybe so according to Bloomberg, the administration wants to raise tariff on Chinese EVs. I mean, not that I don't think they are importing much in the US. I'm not even sure. Certainly in California, we see a lot of Tesla, Rivian, but I haven't seen many Chinese EVs.
Yeah.
So this measure could actually be more for show than for.
Yeah, that's what I was thinking when I said, yeah. But for Europe, if they follow suit, it's probably a big deal.
Yes, Europe is in trouble, and but and they are thinking about implementing their own tariff. But then, as you know, as always, they disagree among themselves. The German, obviously, with their car manufacturing, are the most exposed. The Chinese are trying to play divide and conquer, God knows. But so yeah, it looks like it's more campaign measures than any big economic fundamental measure.
Okay. Anything else stand out that like investors should be looking out for?
No, I think in terms of Fed, they are genuinely waiting for more data. So, you know, we have a number of speakers. They will all go out and give their own little variation on the theme of we have to be patient, some a bit more dovish than others. In terms of data, I think the underlying is still strong. In terms of the politics, if you look at the polls, Trump is still marginally ahead. Biden not doing great in swing states. No, I think that's about it, really.
Right. Okay. And I guess just to kind of highlight some stuff just from this past week, we, ooh, not sure what happened with the website here. I know that Henry, oof, go back. Henry put out interesting piece about now pretty confident about Bank of England cutting in June, which I think has kind of been his call for a while, and now the market's come around to that. China growth tracker, which I feel like there's some really like interesting insights there. And again, it's showing the market indicators, even more real-time data is starting to get more bullish. Now, again, we know Chinese authorities are really trying to, if anything, really reignite the industrial, but also property market. So we'll see there, considering that there's still a lot of froth there. A lot of stuff that we've done across the momentum and carry models. New piece out on energy, which is very interesting. Kind of think that would probably be basing here again. Kind of continuing the theme of Varesh, kind of playing, I guess, kind of this 75 to 90 kind of range, maybe even a bit tighter. Put out a new trade, Aussie Kiwi trade, and this can be done through spot or be done through options. Still have generally the bearish euro trade, and for dollar yen and our general view, Bilal put a great piece out on kind of what we're kind of thinking about, what would make us turn our view and see like a real turn, which it's not there yet, on the kind of a weaker dollar. Mirrors and Akira put out some interesting stuff on Mexican interest rate trade. So a lot of cool stuff that everyone should be checking out. For me, I wish everyone so it's Friday afternoon London time, wonderful weekend and all the best for this upcoming week.
Likewise, and please send feedback, negative feedback, especially helpful.
Yes, amazing point. We are always looking to improve the service, and we always get some great feedback and feedback, and also kind of like a wish list from our professional clients. What can we work on? What can we improve? Which is great. It really makes us, helps us to push us to be the best company we can be. So good luck, everyone.